Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about why the S&P 4400 level is so important right now. So when you're looking at any particular stock or ETF, I think when you use charts, what's most valuable is to focus on key support and resistance levels. A resistance level being kind of a ceiling for that chart, a level above which we're unlikely to go, or a breakout would be meaningful. And a floor, a support level would be sort of a floor, right? A level below which we're unlikely to go. Or if we do break below it, that would be a significant breakdown to note. By thinking of a particular chart in terms of support and resistance level, it just gives us a little more structure to our analysis. Besides, or I guess instead of just attributing a general sense, I'm bullish or bearish on this chart, it gives you a little more structure. I'm bullish above this particular level. I'm bearish below this particular level. And recognizing that normal shift in supply and demand that creates support and resistance levels really reflects the reality of stock and ETF trading going back for decades and even centuries in the case of stocks. Today we're going to talk about the S&P 500, particularly about some support and resistance levels and how you can think of a chart, in this case the S&P 500, like a stoplight. There's sort of that neutral yellow area. There's the green area, the go, which would be we break above a certain level, and then the red area, the stop, meaning we've gone below a key level of support and maybe further downside is warranted. Before we get to the chart, I want to invite you to like this video, subscribe to our channel if you've not done so already. It would really help us a lot if you would do both of those things. And before we get to the chart of the S&P 500, digging into the 4400 level, here's one more thing I wanted to tell you about. Today's video is brought to you by Seeking Alpha. I'm a big fan of places that allow you to better understand the market environment. I think seekingalpha.com is certainly one of those. When you go to the website, I would check out the stock screener, particularly because it allows you to use Seeking Alpha's proprietary quant model. In my experience working with institutional investors, we always had what's called an alpha model, or a quantitative model, which really modeled the characteristics of strong companies, demonstrating strong growth prospects and strong price momentum. Seeking Alpha does a really good job of taking that institutional level quantitative capability and putting it in the hands of individual investors. If you go to marketmisbehavior.com/seeking alpha, or just click on the link in the description below, you can go right to a special offer. If you use the link, you get $50 off your first year and also get a 7-day free trial to check everything out. So go to marketmisbehavior.com/seeking alpha. Now back to the video. All right, so here's my chart of the S&P 500. Obviously, the last couple weeks have been pretty volatile in terms of the equity world. We sold off here in mid to late October, making a new swing low. The S&P threatening 4,100. Certainly felt like we were in a consistent pattern of deterioration, lower highs, lower lows. Last week, we had the Treasury auction, we had the Fed meeting, we had Apple's earnings. Some combination of all of those things, if not all of them, sort of provided some real upside momentum to the market in the second half of last week. Now, this week we've stalled out a little bit. The NASDAQ is kind of pushing out a little bit, but overall the S&P 500 still sort of staying right below that 4,400 level. Now, one of the reasons why my show on StockCharts TV is called The Final Bar is because I would always teach people when I taught technical analysis, to new analysts, I would say you want to start with the final bar and then look to the left. What happens is most novice investors start on the left and go to the right. They read the chart like a book. And what happens if you think about how most charting platforms are designed, that means you're starting with the ticker. The moment you think of this as the S&P 500, you are now all of a sudden unlocking all of those biases in your head, and that is now part of your analysis, whether you want it to be or not. By starting on the right side, even if you kind of subconsciously know this is the S&P, by starting at the right, looking at the current bar, what we call the final bar, and then looking to the left, seeing where we're at relative to where we've been, then the very final thing you look at is the ticker, right? What this stock or ETF actually is. So you do your analysis first, then you reflect on what this actually represents and how that might coincide with your fundamental macro other disciplines and how that relates to the pure technical view of the chart. So I mentioned 4,400, and I think that's important for a couple of reasons, but mainly because that was the swing high in October, right? A downtrend is a pattern of lower lows and lower highs. That's what Charles Dow taught us 125 odd years ago. So if we would break above S&P 4,400, that would make a new high, or at least a new swing high. And all of a sudden, that pattern of lower highs and lower lows would be broken. I would say at that point, you could probably assume that it's a more bullish configuration for sure, the fact that we're not making lower highs anymore. Now, on the downside, 4,200 is a really important level. That was the resistance back here in February. We sort of stalled out here in April and May of this year before finally breaking out in late May, early June. Then we came down and kind of bounced off of just above the 4,200 level in early October. We broke down through 4,200 in late October, which is one of the reasons why, by my view, the market certainly looked a lot weaker than it had in quite some time. But we've now, last week and a half, pushed right back above that level. So now I would argue we're kind of trapped between the 4,400 level and the 4,200 level. 4,200, actually 4,180 is also an important Fibonacci level, which we'll get to here in a minute. So we've talked about some of the key levels. We've started at the final bar and looked to the left and thought about what this chart is actually telling us. Now let me show you how I think we can visually represent that analysis in a much richer format. Here we're using what I would call a stoplight technique, which is basically saying above a certain level is pretty bullish, below a certain level is pretty bearish, and in the middle, I think it's wait and see mode. Jesse Livermore famously said there's a time to go long, a time to go short, and a time to go fishing. So the green area would be the time to go long. The red area would be the time to go short, anecdotally speaking. And then the yellow area would be the time to sit on your hands or the time to go fishing, time to wait it out and just see how things develop. This is why when I'm seeing a lot of buzz and hearing a lot of comments on social media, people being super bearish or super bullish, and I will tell you, financial media often encourages us to be very polarized in our opinion, kind of neutral. It doesn't play well in the media, so you're often asked to take aggressive, positions or aggressive ideas or outlooks to the upside or the downside. In reality, I would say this is one of those times when you have to be patient. If you're bearish right now, I think you're ignoring the strength of the move off of the lows, the improvement in breadth, things like the Zweig breadth thrust, which have triggered and indicated a potential further upside. If you're bullish right now, you're ignoring the fact that most stocks are actually having a pretty weak 2023, right? The equal weighted S&P is actually flat for the year. The Russell 2000 is actually down in 2023, while the NASDAQ is up NASDAQ 100 is up 40+%. So I think in either case, you're ignoring some of the evidence to sort of validate what you're already thinking. And I would argue confirmation bias is alive and well here in November of 2023. So let's talk particularly about the stoplight technique, what it tells us about the S&P here, what sort of levels we're looking for. Here you can see we're in this neutral sort of amber yellowish color, and this is really from the 42 to 4,400 level. 4,400 comes from that high from October. Also, if you take a trend line from the highs in July, August, and September, you can see that lines up pretty well just above where we're at right now and right around that 4,400 level as well. So a break above 4,400 would also take us above that key trend line, which I think is important. Worth noting, by the way, the NASDAQ 100 already broke that trend line. I put a video up last week addressing that particular configuration with the NASDAQ breaking out. I'll put a link in the description below if you missed that one. Now on the downside, 4,200, that was a significant resistance level earlier in 2023, I think has now become an important support level. We almost broke it there in October, but we held 4,200 and we held the 200-day. Those things both failed here in late October. And then one of the more bullish things I've seen in the last couple months is the fact that the breakdown of 4,200 did not last. The key with this stoplight technique is once you break through the level, it's all about remaining in that area, and that sort of further validates the signal. The fact that we only spent a couple days before rotating right back up tells you false breakdown really didn't stick. So a break below 4,200 would take us back below the 200-day moving average. It would take us back below the October low and put the late October low back into play, and would also take us below the 38.2% Fibonacci level. And that's if you take the October 22 low, the July 23 high, 38.2% of the way down at 4180. So a break below 4,200 gets us below that level of support as well. I would argue that unlocks the door to the further downside around 4050, if not 3,900 and more. So that is how I would think of the S&P 500 right now, using what I call a stoplight technique, thinking of this middle range as kind of neutral. So as much as you might be tempted, and I know on social media, you'll hear a lot of buzz about the market's going up, and you're an idiot if you think the market's going down, or the market's going down and you're an idiot if you think the market's going up. I would much rather just focus on the evidence. And right now, I would say at best, the S&P is neutral because we're sort of in the middle of this kind of well-established range. Now, a break above 4,400 gets us into the green shaded area. I would argue that means a retest, certainly of the July highs, if not further. And the seasonal strength of November and December really plays out as you might expect on an average year. We break down through 4,200. We get to this red shaded area. I would say the market bucks the trend of the normal seasonal strength in the fourth quarter. Maybe relives sort of a 2018 type of period. We actually sold off in November and bottomed out in mid-December before a brief rally into the year end and through the holiday season. So overall, those are the levels I'm looking at. Which levels do you think are most important? And if you were creating a stoplight on your chart, what levels are most important in your opinion? Drop a comment below and let me know. I'd be interested to hear your perspective. For Market Misbehavior, I'm Dave Keller. Be well and stay safe, and I'll talk to you again soon.